Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Looking at HIMS, holy crap, it's up 10% today. Oh my goodness, it's down 32% in the past 5 days. Oh wow, it's up 43% in the past month. A lot of volatility in this name. If you think about the drop it had after earnings, after the news that GLP-1 shortages are coming to an end, you have to put that in perspective because the stock has gone up from 30 bucks 1 month ago to 70 bucks to 43 bucks. It's still up quite a bit. Obviously, if you bought when it was trading at 70 bucks, you're unhappy. If you're trading short-term options, maybe you're unhappy depending on the result you got. But this is a stock that's up 73% year to date, up 320% in the past year, and doing really, really well in the last couple of months because of the expectations of growth. So any reduction in the past 5 days is driven because of those expectations changing a little bit. You look at the actual results from their Q4 earnings, they're really freaking solid. Q4 revenue growth, pretty freaking impressive. 95% growth for the full year, 69% growth. So accelerating. A lot of that is GLP-1s. However, growth without GLP-1s still pretty impressive when you splice out GLP-1s from this 1.5 billion for 2024. You're still growing in the mid 30% range. GLP-1s certainly helping, but the other part of the business growing at a good clip as well. And the important part here is they're free cash flow positive. They do have about 90 to 100 million in stock-based compensation, so keep that in mind. That's included in here. So there's some dilution happening. 2.2 million subscribers. This is very much a business that is growing subscribers, hoping to keep them on the platform as long as possible, hoping to reduce churn. But the majority of this business right now is still essentially spending a ton of money on marketing, getting new subscribers in, replacing the ones that they lose, and trying to grow revenue that way. It's growth in subscribers plus increasing their monthly online revenue per average subscriber that's going to grow revenue. That number is going up sequentially and on a full year basis because of those GLP-1s. Those are costing anywhere from 150 plus per month. So obviously, as you add more people who want those drugs, they're going to improve your monthly online revenue per user. The worries are going to come from the idea that these GLP-1s are being offered by HIMS because there's a shortage that the standard drug companies can't fulfill. Now that shortage is coming to an end, which means that they will no longer be able to produce and sell the standard offerings of GLP-1s that are out there. The personalized ones are still going to be available, but it's tough to say how much of that is going to drive revenue growth in the future. Still, one has to remember that this is a business that's built from basically nothing, was a small men-focused business with dermatology for men, sexual health, drugs for men. They added a woman-focused dermatology business, mental health in 22, then weight loss in 23. And they're building on top of that. They're scaling these smaller modalities into larger businesses. They have personalized products and services that they're adding, a variety of things, making this a more interesting business. And their focus on further acquisitions. They just acquired a lab. They acquired a peptide factory. I think they're trying to build out this holistic healthcare product that is going to allow people to get a variety of things looked at and covered and prescribed and that's certainly playing out well in the last couple of years, as evidenced by the growth here, as evidenced by the stock price. They've got 5 different specialties now that are going to have 100 million plus in revenue in 2025. There's sexual health, men's dermatology, women's dermatology, mental health, weight loss, and 25% of their revenue in 24 is associated with the HERS brand, with investments across women's dermatology, mental health, and weight loss. That's pretty freaking interesting and pretty exciting if you're an investor in this company. Still, you have to remember that this is very much a marketing, branding business. They're building out this brand, trying to become the biggest player in this telehealth, prescription, etc. space. And they're doing a good job there. They probably have about 40 to 50% of the market share, growing much quicker than some of their competitors. But they're still spending a ton of money on acquiring subscribers. The second step after acquisition is trying to not lose them, trying to not churn those customers over. So it's retention, it's customer experience, good results, specialized content and tools that others can't offer. And they're building that out with the acquisitions of peptide factories, of laboratories, of these various compounding pharmacies that they're working with, that they're adding to their platform, where you can go here and you can get a GLP-1 because there's a shortage for a fifth of the price of the actual drug when you get it on the market. And that's an interesting value proposition for the consumer because they see this as something that can save them money. And in the long run, they might come back to something like this because it's like, hey, this may be cheaper than just going to the doctor and getting a standard prescription. And it's certainly a lot easier because I can do it all online. So after you sort of go through this process of acquiring, try to retain them, it's retention, it's making them adopt multi-month subscriptions, selling them proprietary products like supplements and combinations of supplements and generic drugs, and then increasing the product offering breadth that's out there. It's adding mental health, it's adding weight loss, it's adding more. I'm sure there's more stuff coming that we haven't heard of yet, but there's certainly more coming in the future. And I think, the idea of having compounding pharmacies is not just to make GLP-1s, they can do other stuff with that. I personally take a B12 injection every other day because I have a health issue that doesn't allow me to get B12 naturally. So I go to a compounding pharmacy to get that. Can HIMS in the future do stuff like that? Can they acquire these smaller compounding pharmacies and offer these unique healthcare things that aren't necessarily done through a standard pharmacy and allows them to access a new channel of subscribers that isn't there yet? So revenue growth is driven by expanding the subscriber base, and that can be worrisome. When I look at this, it worries me a little bit, and I'll take a look at that in a second. But it's growing that subscriber base. You can see that growth is coming, especially on the personalized side, and those personalized solutions probably have a better retention rate than the non-personalized solutions. And then it's a combination of that plus increasing that monthly online revenue per subscriber, and that number is pretty steady for quite some time, but is ticking up now due to those GLPs. The worry is obviously going to be once those GLPs come off the platform, is that number going to tick down? Is that number of subscribers going to tick down? I think that's why investors are a bit wary after that earnings release, because the earnings release was good and the guidance was decent, but I'm just not sure that people trust the idea that their weight loss product is going to grow at such a good clip in 25, despite the fact that they're going to potentially lose the ability to sell GLP-1s as early as May of 25. And certainly one concern here is that you've got this number growing $73 from an average in the mid 50s a couple of months ago. And a lot of that is because of those GLP-1s. So once those GLP-1s flow off in May of 25, and maybe you can replace them with a generic that you've got cooking, maybe you can replace them with the personalized semaglutide. But end of day, if this number starts trending downwards or getting back to that $55 number, that growth could really fall off a cliff. On top of that, you're becoming a more mature company here in HIMS. You've got 2.2 million subscribers, still growing at a good clip, but you're very much a marketing company, and you're marketing to people that are interested in this sort of service. And when you look at some of the graphs they showed, they've already got 45 to 50% of the total market here, and the market's growing, so there's more opportunity for growth. But is it going to be harder for them to grow subscribers on a go-forward basis beyond where they are today? And how much is that going to cost? Is marketing becoming more efficient? They do talk about how they have strong unit economics, they can scale with confidence, but they use gross profit numbers to show this calculation here, how Q1 24, their cohort that they spent $113 million in marketing to acquire, by Q4 24, they have $156 million of cumulative gross profit, which is great. Gross profit is nice. They have nice gross margins in the 75% range, but there's still marketing expense within that number that goes every single quarter that they use to replace people that churn. There's SG&A expenses, there's R&D expenses, other stuff that overall net profit is probably, 10% of that, if that. So you're looking at this expense. How much are you actually making in the bottom line from these people? It's probably, maybe $10 million out of $113 million in paid marketing expense. So long term, will this cohort make money? Probably, but it takes a long, long time to actually get net profit from these people because of how much you're spending on marketing. And one thing to note here is that clearly this is illustrating significant churn within any of these cohorts. You've got $69 million in gross profit in Q1. If you were to continue that across the entire year or even into Q2, you'd expect 69 times 2, $138 million. That's your cumulative gross profit if everybody renewed, if everybody stayed on their prescription. But that's not the case. You go from 69, and then additive profit to that is $32 million in Q2. Additive profit to that is $30 million in Q3. Additive profit to that is $25 million in Q4. So there's pretty significant churn. So what that means is that every time you're looking at a new quarter, that cohort is becoming smaller and smaller. Some people stay for a a long, long time. You might get people in this cohort that stay for the entire life, and that's good. But there's a lot of people in this cohort that use the product for a month, use it for 2 months, and then just quit the platform. So when you look at these numbers, remember that, yeah, they're adding a bunch of people, but they're also probably losing a bunch of people within this platform. They're just replacing them with more people than they've lost for additive growth. So as I look at this, what I kind of like looking at is this is the number of subs each quarter, the number of subs added on a quarter over quarter basis, and how much marketing they've spent to get that number. There's a small number in Q1 23, so maybe that's an aberration. But in general, I'm looking at how much dollars are they spending to acquire each Ned sub. They're losing a bunch of subs within each quarter, but they're adding more than that. So when I look at Q4 24, for example, what I mean by that is they may have lost 300,000 people to churn, but they added 482,000 because of marketing to new customers, etc., getting new customers, reactivating old customers, and so on. So you've got a bunch of churn. Who knows what it is? Hard to tell. They do share that their long-term retention rate is 85%, which again is good, but that's only for people who have been on the plan for 2 years or more. So short-term retention is probably a lot worse than that. So there's significant churn and the need for significant marketing spend continually replacing that churn. So you've got $1,178 being spent on each subscriber in Q2 23, Q4 23, $1,134. Q1 to Q3 show a little downturn, and then a big uptick in Q4 24, maybe marketing to a different clientele to kind of try to market those GLP-1s that they have on the books now, costing them $1,200 to add each additional subscriber. So when you think about this, is the real expense for each net subscriber to add a person to the plan after accounting for churn, and each one of these people is probably spending $70 on average per month. It's going to take a while to see payback from some of these cohorts on a net income basis. So they're spending a lot of money. And the thing that worries me, if I were an investor, I'm not right now, but I'm certainly thinking about it. I do kind of like the business, is that how efficient are they with their marketing? Are they getting more efficient? Right now, it doesn't seem like they are, because on a year over year basis, marketing spend per sub has gone up. From a percentage basis, as a percentage of overall revenue, marketing may be coming down because their revenue is growing faster than marketing spend. But at the end of the day, a lot of that is due to the fact that those people are using more expensive drugs. If that changes and their marketing spend still is up here, that could be a pressure point to their margins. That could be something to look out for, because once you get to Q3, when those GLP drugs are off the plan, if that average revenue per user comes down and marketing spend is still up here, that could show some margin pressure going into the latter part of 25, going into 26. And I think that's kind of what investors are worried about. It's like, how efficient are they with their marketing? How far can they grow from here, given that they're already 45 to 50% of the market share based on the graphs that they're showing? And how confident are we in the fact that this number, which is as high as it's ever been, is going to stay up there versus coming down in the future? That's, I think, the worries that is driving the stock price down from where it was after the earnings, despite the fact that the earnings themselves were pretty good. And then as you look at the outlook for 2025, some of those worries do show up. And you see that in the idea that FY25 growing at 60% is slowing from what they're projecting for Q1 25 growing around 90%, which is, again, freaking impressive on both ends. You can't complain about that. They're still selling GLP-1s into Q1 and into part of Q2, so the growth there is going to be solid. Higher revenue per user because of that, higher growth overall. Then as you move into Q2, out of Q2 into Q3 and Q4, probably some slowdown in growth. Again, you're comparing against the higher comparable in Q3 and Q4 24 because the GLP-1s are already in there. So still growing there is pretty impressive. You've got 56 to 63% growth. They're still aiming for 725 million in weight loss revenue. So that's kind of impressive in my mind. I think investors are worried that that's a bit aggressive, given that they might not be able to sell semaglutides by May or so. However, they still feel like they're going to be able to sell personalized semaglutides. That part is in the guidance here. It's that oral weight loss program that they have, a generic drug that's coming out that's going to help with weight loss. It's not as efficient as semaglutide, but might be a good transitionary drug for people who can't afford the real thing on the open market. And then the personalized semaglutide for people that can't handle the doses that are out there commercially. That's what this is all about. And even without this number, even without the 725, if you compare no weight loss for 25 and no weight loss for 24, you're still showing 30 to 35% growth, maybe even a bit above that, which is pretty impressive. Again, they talk about the long-term retention here. I kind of talked about why that's sort of nonsense, because it's only for people who have been on the plan for 2 years or more. So you're going to have better long-term retention. I kind of wish they'd share what the short-term retention was, because that really goes into hand in hand with this payback period. However, this is still an interesting company. They have this personalized portfolio that they're growing, a lot of personalized offerings. It's not just the dermatology and sexual health that they had in the past. It's a bunch of other stuff: mental health, weight loss, personalized weight loss offerings. They're acquiring other healthcare adjacent things like laboratories, like peptide companies. And I think when you talk about this compounded medication field, it's pretty interesting because it allows for a variety of healthcare offerings that offer a more holistic approach. And it's an easy to access form of healthcare for people who might not have that access otherwise. It's a way to do it relatively cheaply and, more importantly, relatively comfortably from the safety of your home. And that's what I like about this business. On top of that, the financials are looking really good, but you always have to be concerned about the potential for a slowdown in growth. There's many companies that have grown really quickly that have been rewarded by the stock market, but from a long-term perspective, once that growth slows down, it can happen really quickly. The punishment can be pretty severe, as evidenced by what we saw just in the last couple of weeks. Valuation disclaimer: this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Here's my handy dandy spreadsheet. There will be a link to this in the description down below. Hit file, make a copy if you want to make changes to any of these assumptions. You've got a 2% free cash flow yield based on 24 actuals, a 2.9% free cash flow yield based on 25 estimates. Keep in mind, these free cash flow numbers do have a little bit of stock-based compensation in there, about 100 million for 24. Still not a terrible valuation based on the growth that we're seeing here. The question becomes, what's the growth going to be like in 26 onward? I've got 56% growth in 25, 12% free cash flow margins, kind of close to what they're guiding on the bottom end for 25. And then 26, I think, is going to be a tough year to predict, because you've got this baseline in 25 where you saw amazing growth due to GLP-1s, due to a lot of subscriber additions. Will marketing be as successful going into 26? That's the question mark. I'm being a bit more conservative with 15% growth here, down to about 6% growth by 29. Maybe too conservative, who knows? You can certainly play around with these numbers. Free cash flow margins, I've got 12.5% in 26, up to 14% in 29. Again, maybe conservative here because their long-term guidance is 20 to 30% EBITDA margins. Adjusted EBITDA margins probably means closer to 20% free cash flow margins. So maybe some upside here if they can actually hit that, if you believe management. They're doing a lot of cool stuff in terms of the acquisitions they're making, in terms of the holistic approach to the offerings they have, and the expansion of their business into other areas. And they're certainly succeeding in taking market share. From a cash flow perspective, I'm putting 50% of their cash flow towards buybacks, offset by stock-based compensation. There's about $1 billion in excess free cash flow they can use for more buybacks or acquisitions or whatever. I think they will be making more acquisitions, kind of expanding their breadth of offerings. When I look at free cash flow valuation in 29, 4% seems about right. At that level, I get about a 6% expected return from the $43 price point. If you disagree with that, you can certainly place it in a 3% free cash flow yield, gets you to about a 12% expected return. If I'm aiming for a 10% target return with the assumptions I've made here, I get a fair value of about $36. If I'm aiming for a 15% target return, because this is a volatile stock, a more risky speculative stock, I get about a $28.99 fair value. That's kind of where I would be if I was to buy this company. I do like the business. I do like the growth. I'm concerned about the level of marketing spend they have to drive to get that growth, and that's not ending anytime soon in my mind. I do think as they scale, the marketing does kind of scale better with a larger revenue base. So, yes, your margins will improve, but you're still having to spend quite a bit of money on these acquisitions. I think long term, the thing they could benefit from is some of these specialized offerings. If that helps their short term retention, we really talked about that payback value. That payback period, the long term retention, and how that translates to short term retention. Some of that stuff worries me, which is why I'd be a more concerned investor if I were to buy this stock. Just because it's trading at 43 bucks and it traded at 68 bucks doesn't mean it's a good deal today. I feel like that mid to high 30s range is probably more reasonable from a fair valuation with reasonable assumptions, with some upside from there in relation to the growth assumptions and free cash flow margins. However, if you're a conservative investor like I am, I'd probably be in that like high 20s range to start a position here. And I'm not really interested in starting a position. I just wanted to take a look at this company, add it to my watch list, because this is very volatile. So if it suddenly starts trading in the 20s again, I'd probably start to nibble, because I do like their growth potential. I do like what management is doing. There are some concerns here around short-term retention rates, how much they're spending on marketing and all that stuff. But the business itself is humming along. The stock price is obviously being rewarded because of that. However, if you're thinking of buying today for a long-term perspective, I think it's a bit pricey. What do you think? Leave a comment down below. And as always, like and subscribe. And welcome to all of the new subscribers who have joined the channel in the last couple of weeks / months. I'm glad that you're enjoying the videos. And for all of you that have stayed around for the entire video, I appreciate you. Leave a comment down below if that's you. So thanks for watching, and bye.